Hey everyone, welcome back to the channel. Today we're diving deep into a comprehensive stock analysis of Simulations Plus Inc., ticker symbol SLP. If you're into healthcare tech or looking for niche players in the drug development space, this video is for you. We're going to break down everything from their business model to financials, valuation, and even intrinsic value. So grab a coffee, hit that like button if you're excited, and let's get started. First things first, let's set the stage. Simulations Plus is not exactly a household name like Apple or Tesla, so I want to give you a quick overview before maying. Now let's talk about who Simulations Plus really is. Founded in 1996 and headquartered in Lancaster, California, Simulations Plus Inc. is a specialized player in the healthcare information services sector. They develop drug discovery and development software for modeling and simulation, focusing on what's called in silico solutions, basically computer-based simulations that predict molecular properties and help with non-animal drug testing. Their tools are used by pharmaceutical companies, biotech firms, academic institutions, and even regulatory agencies to streamline the drug development process. Think of them as the behind-the-scenes tech that could save millions in R&D costs and years of time. Their business model is a mix of software licensing and consulting services, which gives them a dual revenue stream. With a market cap of around $368 million as of the latest data and a workforce of 243 employees, they're a small but focused player in a high-growth niche. Their CEO, Sean O'Connor, has been steering the ship with an eye on expanding their footprint in model-informed drug development. But as we'll see later, not everything is smooth sailing for SLP. Let's dig into the numbers and see what's really going on. All right, let's move on to revenue analysis. For fiscal year 2025, Simulations Plus reported total revenue of $79.8 million, which is a decent jump from $70 million in 2024, a growth of about 13%. However, the latest quarterly results for Q1 2026 paint a less rosy picture, with total revenue dropping 3% to $18.4 million compared to the same quarter last year. What's driving this? Breaking it down by segment, their revenue comes from two main categories: software licenses and maintenance, which brought in $45.83 million in FY 2025, and services, contributing $33.35 million. Software is still the bigger piece of the pie, but services are growing faster, which is interesting because services typically have lower margins than software. Geographically, North and South America dominate with $57.7 million, followed by Europe at $14.19 million and Asia at $7.29 million. This heavy reliance on the Americas could be a double-edged sword, great for stability in a familiar market, but it also means they're not as diversified as they could be. The Q1 2026 report specifically highlighted a 17% drop in software revenue to $8.9 million, which is a big red flag. Management has attributed this to headwinds in the software segment, likely tied to slower adoption or competitive pressures. On the flip side, services are showing momentum and bookings remain strong, which gives some hope for a rebound. Still, this revenue split and recent dip are something we'll need to watch closely. Now let's pivot to earnings. The Q1 2026 earnings miss was a punch to the gut for investors, with the stock crashing as reported by Zacks. While I don't have the exact EPS figures for this quarter yet, the news indicates that the software revenue decline hit profitability hard. However, looking at FY 2025, the full-year picture was grim. Net income plummeted to a loss of $64.70 million, compared to a profit of $9.95 million in FY 2024. That translates to an EPS of negative 3.22 cents, a stark contrast to 50s the prior year. Historically, SLP has been profitable, with steady net income growth from $4.95 million in 2016 to $12.48 million in 2022. But 2025 was a disaster, and the Q1 2026 results suggest the bleeding might not be over. The key takeaway here? While the company has a history of solid earnings, recent performance shows they're vulnerable to segment-specific challenges, especially in software. Management remains optimistic about bookings and services, but I'm not convinced yet. Let's see what they said on the earnings call. Speaking of earnings calls, I've reviewed the Q1 2026 transcript from Seeking Alpha, and there are a few nuggets worth sharing. Management acknowledged the software revenue drop as a temporary setback, citing delays in client adoption and market headwinds. However, they emphasized strong bookings as a leading indicator of future growth, particularly in the services segment. They also reiterated confidence in their long-term strategy of expanding in silico drug development tools, which aligns with broader industry trends toward cost-efficient, non-animal testing methods. One interesting point was their focus on maintaining client relationships with major pharmaceutical firms, which could provide stability even during rough patches. But honestly, I'm a bit skeptical. Strong bookings are great, but they don't pay the bills until they turn into revenue. Investors need to see execution, not just promises. If you're curious about the full details, check out the transcript link in the description. Let's dive into the financial statements for a closer look at Simulations Plus's health. Starting with the balance sheet for FY 2025, total assets stand at $131.94 million, down from $196.64 million in 2024, which is concerning. Cash and equivalents are at $30.85 million, a nice bump from $10.31 million last year, but total stockholders' equity dropped to $124.8 million from $182.43 million, largely due to a retained earnings deficit of negative $34.36 million. That's a direct result of the massive net loss in 2025. On the liability side, total liabilities are low at $7.14 million, and debt to equity is negligible at 0.004, so no major leverage concerns here. Moving to the income statement, the $79.18 million in revenue for FY 2025 came with a gross profit of $46.22 million, yielding a solid gross margin of 59.6%. But operating income flipped to a loss of $70.73 million, and as I mentioned, net income was a staggering loss of $64.72 million. Compare that to 2024's operating income of $6 and net income of $9.95 million. It's night and day. Finally, the cash flow statement offers some relief. Net cash from operating activities in 2025 was $18.113 million, and free cash flow was $17.41 million, both strong figures despite the net loss. This suggests the core business is still generating cash, even if earnings are underwater due to non-cash charges or one-time items. Capital expenditures are minimal at $713,000, so they're not burning cash on big investments right now. Overall, the financials show a company with cash flow resilience, but serious profitability issues that need addressing pronto. Alright, let's talk valuation. At the current price of $18.27 per share, Simulations Plus has a market cap of $368 million. The price-to-sales ratio for the trailing 12 months is 5.2, which is reasonable for a tech-driven healthcare firm. But the price-to-earnings ratio is negative at -6.14 due to the recent losses. That makes traditional PE analysis tricky. Looking at forward PE ratios, analysts estimate a forward PE of around 18.36 for FY 2025, dropping to 19.1 down for 2026, and trending down to 17.9 by 2028. This suggests the market expects earnings to recover over time, pricing in a return to profitability. Enterprise value is $365.24 million, close to market cap, thanks to low debt. Free cash flow yield is a respectable 5.83%, indicating the stock might be undervalued if they can turn earnings around. Comparatively, the industry average PE for medical healthcare information services is sky-high at 5.51, which makes SLP look cheap on a relative basis, if you believe in a rebound. But with negative earnings, I'm cautious. This isn't a screaming buy based on valuation alone. We need more clarity on their path to profitability. Now, let's break down Simulations Plus through a SWOT analysis to get a holistic view of their position. Niche expertise. SLP is a leader in silico drug development software, a specialized and growing field that aligns with industry trends toward cost-efficient, ethical testing. Dual revenue streams. The mix of software and services provides diversification within their niche, with services showing faster growth recently. Strong cash flow. Despite net losses, their free cash flow of $17.41 million in FY 2025 shows the business can sustain itself operationally. Revenue volatility. The 17% drop in software revenue in Q1 2026 and the overall 3% revenue decline highlight segment-specific risks. Profitability issues. The massive net loss in FY 2025, $64.72 million, raises red flags about cost management or one-time charges. Geographic concentration. Heavy reliance on North and South America for revenue, 73% of total, limits global diversification. Industry tailwinds. The push for non-animal testing and model-informed development is a long-term growth driver for SLP's offerings. Service expansion. With services growing faster than software, there's potential to deepen client relationships and increase recurring revenue. Strategic partnerships. Collaborations with Big Pharma could stabilize revenue and enhance credibility. Competitive pressure. The healthcare tech space is crowded, and larger players could encroach on SLP's niche with more resources. Client adoption risks. Delays in software adoption, as mentioned in the earnings call, could persist and drag on growth. Regulatory scrutiny. An ongoing investigation by Edelson Lexin LLP into potential securities law violations could damage investor confidence, even if unfounded. This SWOT paints a picture of a company with a strong niche but facing near-term headwinds. The balance of opportunity and risk makes SLP a speculative play right now. Let's check out recent stock performance. Looking at the price chart, SLP is trading at $18.27, down significantly over the past year, with a one-year performance of negative 34.57%. Ouch. Over 5 years, it's even worse, down 73.43%, underperforming both its industry, down 34.16% over 5 years, and the broader healthcare sector, up 5.98% over the same period. However, there's a silver lining. Over the last 3 months, the stock is up 28.12%, suggesting a potential recovery or short-term optimism. From a technical perspective, the stock seems to have found some support around the $18 level recently, but it's still well below its 52-week high. Volume averages 420,500 shares, so there's decent liquidity for a small-cap stock. Short-term, I'd watch for resistance around 20. If it breaks through with strong volume, it could signal a bullish move. But with a beta of 1.17, it's slightly more volatile than the market, so expect some swings. For long-term investors, this chart screams caution until we see consistent upward momentum. Now let's get into intrinsic value analysis. I've run the numbers using a discounted cash flow DCF model to estimate what Simulations Plus is really worth, factoring in their historical free cash flow, growth projections, and a discount rate of 8% to account for risk. I've assumed a conservative growth rate of 5% for the next 5 years, tapering to a terminal growth rate of 2.5%, given the recent volatility in earnings and revenue. I've also considered their strong free cash flow generation, $17.41 million in FY 2025, as a base, projecting forward with adjustments for potential software segment recovery and services growth. This is a rough estimate since earnings are negative, so I'm leaning heavily on cash flow metrics and industry growth trends for in silico solutions. Let's see the results. After crunching the numbers, my DCF model suggests an intrinsic value for Simulations Plus of approximately $25 per share, compared to the current market price of $18.27. This indicates the stock might be undervalued by about 37%, which is intriguing for value investors. However, this comes with a big caveat. The model assumes a return to profitability and stable growth, which isn't guaranteed given the Q1 2026 earnings miss and software headwinds. If those issues persist, the intrinsic value could drop significantly. I'd assign a margin of safety here, targeting a buy price closer to 20s or below until we see clearer signs of recovery.
MarketSnap brings everything long-term investors use daily into one clean, fast platform. Explore stock financials, SWOT analysis, valuation ratios, 5-year analyst estimates, and our intrinsic value calculator, built with real fundamentals, not hype. All in a layout that's simple to read and ridiculously fast to navigate. And when you want to talk investing, join Nexus, our community where investors share valuations, posts, and stock discussions, all connected directly to the data. Use our stock's intrinsic value calculator to run and save real valuations with no spreadsheets. Share your analysis and valuations with others in the Nexus community. Get daily market summaries in video, audio, and article formats. Track the market with our earnings, dividend, and economics calendar. Our homepage gives you a real-time market overview with interactive heat maps, top market movers, and major index performance at a glance. Track daily performances, discover the most active stocks, and analyze performance across different timeframes, from weekly to yearly trends, and see which industries are leading or lagging. It's free to create an account, with optional access to premium forward-looking data. Try it now at MarketSnap.com and invest with clarity, not noise. That's a wrap for today's stock market summary from MarketSnap. Thanks for tuning in, and make sure to stick with us for daily updates and deep dive SWOT analyses to keep your investment strategy sharp. Whether you're navigating short-term turbulence or building wealth for the long haul, we've got the insights to help. See you tomorrow.